Hello, you're watching Market Week in Review, the week ending April 17th, 2015. My name is Blair Lowman, and I'm coming to you today from Russell's global headquarters based here in Seattle, Washington, and I'm joined by Chief Investment Strategist Erik Ristuben. Hello, Erik.
Good morning, Blair.
Let's start in the U.S. this week, where earnings season was in full swing. We also received retail sales and jobless claims numbers. How should investors interpret this data?
Well, the market is antsy, right? So you have big three things that have happened in the first quarter. You had oil prices continue to fall. You had the dollar continue to strengthen. We've talked a lot about the dollar strength and the headwind that it poses to the U.S. economy and to corporate earnings. And then finally, we've had bad weather. So you kind of get those three things in confluence. People are really looking to earnings to say, well, how bad is it going to get? Now, one thing to understand is the bar in terms of expectations for corporate earnings this quarter has been lowered significantly. The analysts now in consensus expect about earnings to contract, so get smaller by about 2.6%. So far, we've had about 10% of the S&P 500 report, so a very small number, a lot of banks. And right now, about 80% of the companies, from an earnings standpoint, are crawling over that low bar. And I think we're probably going to just kind of struggle with this. I think the data that the market's really going to be looking at is the kind of data that you talked about: retail data, unemployment claims, and both of those numbers are actually quite good. Other numbers have been more mixed, and we'd had been seeing weak data come through for the last, the prior 4 weeks. We're now beginning to see either strong or mixed data. We think the economy of the United States is going to re-accelerate off that bad weather, and that we're going to see earnings also have a bounce in later quarters. But this quarter, we do not expect a good earnings quarter. We do expect a better earnings quarter in third and fourth quarter.
We did touch on oil a bit, and crude oil prices reached new highs this week. Let's talk about a few of the reasons for this, as well as what investors should keep in mind going forward.
Well, new highs. Yeah. New highs in the context of it's still almost half the price of what it was. So, yeah, I think we're about $56 and change on West Texas crude as we started to film. We started the week at 51 and change, so we're talking about a almost 10% rise in the price of oil, which is kind of interesting. I mean, it's a good kind of remembrance of what drives oil prices, right? Mm-hmm. The fundamental problem we have in the market and why it's in the 50s is there's more supply than there is demand. And even though U.S. shale producers, and we're beginning to see data actually, where U.S. shale producers are now closing down rigs. In fact, in May, the U.S. Oil production is going to be the first month it's expected to shrink. It's still growing now, but in May, so just next month, they're expecting it to drop. On the other side, the Saudis and OPEC in general added 810,000 barrels a day. So you've got these interesting dynamics. And then I think probably a tiebreaker that sent oil up about 10% was what was happening in Yemen, right? So as you probably know, there's been a conflict kind of around Yemen with principally Saudi Arabia. There's some political unrest in Yemen. The government troops that had guarded the main oil field, I think it's the Masali oil field, they left, and now armed local militia are actually guarding it. And I think that's just a view that, and it's not so much that Yemen's a major oil producer, it's not, but it is this notion that geopolitical and political turbulence in the Middle East could affect oil production. And I think kind of the psyche of the market was to drive prices higher this week. We do not see this price continuing to move up. We still think the fundamental supply-demand thing is out of whack, and that oil is probably going to languish at a relatively low price for a while, probably until the second half of the year when you get some rebalancing of the supply-demand dynamic.
Okay, well, now let's wrap up in Europe, which received a mixed bag of economic data, but everyone's focus was on Greece as their financial outlook continues to worsen. What insight do you have for investors as they continue to read these headlines in the weeks ahead?
It continues to be our position that we're not really worried about Greece. They have serious issues. They have a political party that came in. Syriza came in, and they made a whole bunch of campaign promises. Almost all of those promises, folks like me were saying there's no way they can actually live up to those promises. I think there's just been this kind of realization within that government that that's probably the case. But they're going to owe, I think, €1 billion payment to the IMF next month. and so they got to hammer out a deal, and this is, they got an extension, and now they got to actually get a deal done. Right now, it looks for all the world that they'll take negotiations into the 9th, 10th inning, and probably a deal will get done. We think the odds of Greece leaving are actually quite low, but we think the contagion risk of Greece is quite low. So our view is that if Greek concerns cause weakness in the European equity market, it's an opportunity to buy.
Well, thank you as always for your insights, Erik, and thank you. We'll see you next week.